Welcome back. This is Chapter 7, video lecture number 2. When we left off in our last video, we asked ourselves, what happens when customers don't pay us? What's the accounting for that? Well, as shown in Chapter 7, there are two methods to account for bad debts. When a customer does not pay us, it's considered a bad debt. The first method, talked about on pages 274 and 275 of your textbook, is the direct write-off method. And this method is not appropriate in accordance with generally accepted accounting principles because it violates the matching principle. Under the direct write-off method, we wait for an event to happen and debit bad debt expense and credit accounts receivable after that event has happened. Let's explain a little bit more. Some of the events that might happen to our customers that would make us pretty sure that we will never be able to collect the balance owed to us by that customer might be bankruptcy. Maybe the customer died and did not make provisions to pay off his debts. Maybe the customer skipped out. Maybe the customer went to prison. Those are events that happen, and there might be more events, that would make us pretty darn sure that we are not going to get paid. So under the direct write-off method, we do nothing about our receivable. Even if it's 3 years old, we do nothing about our accounts receivable until an event happens. And when the event happens, then we make a journal entry to debit bad debt expense and credit accounts receivable. And remember, this is not a good method to use with generally accepted accounting principles. So let's go through a few examples, then we'll go on to a more appropriate method. So example, we received notice that our customer J. Kent filed bankruptcy. The balance of accounts receivable from J. Kent is $900. What is the journal entry under the direct write-off method? We're going to debit bad debt expense and credit accounts receivable for J. Kent, $900. Occasionally, rarely, sometimes only once in a blue moon, not very often at all, we might recover a bad debt after it's already been written off. Example, a few months after closing bankruptcy, J. Kent won the lottery and decided to pay off all his old bills. 2 journal entries are necessary at that point. One to set up his accounts receivable again, and the second to receive the cash. So to set up his accounts receivable, we need to debit accounts receivable J. Kent for $900 and credit bad debt expense for $900. That's just reversing that journal entry. Now J. Kent's receivable is back on the books, so we can receive the cash, debit cash, credit accounts receivable, J. Kent. When we come back in video number 3, we'll talk about the allowance method. The allowance method is prescribed by generally accepted accounting principles, and we'll talk about it.